You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
All right, everybody, I think we're going to get started. We have a lot to get to and not a lot of time to do it. So if everybody can take their seats, we'll get rolling. We got water delivery going up here. For those of you who don't know me, my name is Mark Longo. I run the Options. I'll take an extra question. I run the Options Insider Media Group. We are a targeted options and derivatives media firm. We produce content for a wide variety of audiences, which is kind of why we're here today. It's a pleasure to be back at STAC. You know, the last time I asked me to come up here, they gave me the dubious task of having to predict the future of financial regulation literally a week before Donald Trump took office. So I don't think we know the answer to that question several years later. So this is a much easier task they gave me this time. They said, "What do you want to talk about for options?" And you know, January is a bit of an auspicious month for us at the Options Insider. That's where we started our firm way back in the dark days of January 2007. So whenever January rolls around, I'm always thinking to myself anyway, looking back at the year we did from a content perspective and what kind of content we produced, how we did, and also how the industry did as a whole. So I thought this January, it kind of coincides with our 12-year anniversary. A lot's happened in that 12 years. So I thought, what better thing to do today than kind of look back at how we view the options market, which is not as clients or as end users. We view it as a media firm through the lens of different audiences. And we tend to break down the options market into 5 general buckets, general silos of audiences. There are subsets within there. We can go on for hours. We won't do that. But in general, we kind of look at it from 5 different perspectives. There's the overall retail, which includes obviously a bunch of subsets, basic, intermediate, advanced, all that stuff. There's the general kind of institutional crowds, the guys who are putting through 10,000 lots on various products there. There's the advisor, the RIA, asset manager audience, an important new one. There's kind of the market maker, trader / liquidity audience, and then there's kind of the stack audience as well, which is we kind of loosely lump together as the industry / professional crowd. And you know, producing content for these different audiences is a bit of a daunting task. When we launched all the way back in the dark days of 2007, there really were only 2 primary audiences that we had to look at. We had to look at retail, which was primarily back then basic and intermediate. There was a nascent advanced retail scene, but nowhere near what it is today. We'll get to that in a little bit. And then of course we had kind of the institutional / professional crowd. And that was kind of it. But there was this huge chasm, this huge, what I call the gray zone in between, where there was a lot of space, and quite frankly, not a lot going on. And then fast forward 12 years to here we are, Jan 2019, and there's a ton going on in that gray zone. So I thought that's what we'd focus on here today. What's going on from an evolutionary perspective across these broad array of different marketplaces, and I wanted to bring kind of a diverse array of perspectives to help me do that. People who look at the options market and these audiences from different ways. To my immediate left, I have Brian Overby. He is the senior options analyst, aka the options guy over there at Ally Invest. Next to him, of course, Tony SALIBA. He wears many hats these days, including CEO over there at Matrix Holding Group. Then we have we have a stacked panel here to coincide with STAC. If you don't like that joke, that's Bill Looney's joke, by the way. He made me say it. Next to him, we have, of course, Bill Looney. He is the head of index option strategy over there at the CBOE. Next to him, again, kind of mixing up the perspectives a little bit, we have John Cherry, the global head of options over there at Northern Trust. And then next to him, we have Jim Hyde. He's the head of business development over there at NYSE Options, also wears a lot of hats over there as well. And last but not least, all the way in the corner there, we have TOBY Joy. He is the head of trading over there at AKUNA Capital. So let's get into this, and by the way, this is going to be a bit of an interactive panel, so while we're playing along, I'm going to toss some polls to you guys. I'm also going to give you, kind of set the stage a little bit, give you some kind of historical perspective of how, just overall, how the market, how these different audiences has evolved. Back in 2007, when we launched, there were a whopping 6 exchanges, and it seemed like a ton back then, didn't it? Now we have 15, and more apparently are on the horizon. Also, volume-wise, back in 2007, the industry put about 2.8 billion contracts out that year. A robust year, but a kind of a pale shadow of what went up in 2018, which was, of course, a record-setting year, which was 5.1 billion, which brings us to our first poll. Hopefully you guys have the app up and running. If not, fire that bad boy up, because we have a bunch of polls going. The first one is a pretty simple one. We're going to ask you guys, quite frankly, do you think that the industry can top that number, that 5.1 billion number for 2019? I'll keep an eye on the results here. But we'll check out through that throughout the panel. Also, other highlights, maybe a dubious one with 2007. We launched in conjunction, which at the time was the penny pilot. That launched about a week after we did back in January of 2007. It launched with Whole Food options. And then over the next couple of weeks, they added pretty much 12 more classes. They added GE, they added Microsoft, Intel, you name it, and we all are kind of living still in a post-penny pilot world, which is an interesting one and probably could be a subject of a panel in and of itself. But let's get rolling. Again, I want to look at the different audiences we have here. One of the things, people hit me up all the time with queries about these types of events, saying, how come there's not more retail on these events? How come there's not more retail perspective? I don't know why they ask me. I don't plan the events. I just come to speak at them. But I thought we'd mix it up a little bit today and start retail first. But that's an area where there's been a lot of evolution. Quite frankly, some of the most evolution we've seen back then since 2007. We of course have the evolution of the super high-end, super sophisticated retail guy. We've seen the arms race with the different brokers out there who have just made it effectively viable to be a pro or a semi-pro trader in a retail account now. We also have things like the evolution of margin. We have portfolio margin for retail now. So all of these things and of course commissions have come down quite a bit as well. So we've seen a lot of evolution on that front. Brian, I'm curious, as also this 12-year period kind of dovetails nicely for you guys, because you guys launched Trade King back in January of 2007 as well. So this kind of 12-year period is a bit of a landmark for you. You're in the retail hot seat today. Walk us through what that 12 years has been like, and what's some of the crazy evolution you've seen in that retail audience over the past that time frame.
Yeah, basically when you launched Options Insider, we launched Trade King, and eventually we got bought out by Ally Bank, and now we are Ally Invest. And what the biggest thing I think that I find amazing is there wasn't an iPhone when we launched, and how much of a difference that has made for the retail person overall, in that you got to build an app. And that app, there's now brokerage firms like Robinhood out there that only have an app and don't have a site to go along with it, which wasn't even feasible back in the day. So the biggest thing on the retail side is a few of the things that Mark mentioned is the tools that are available. Inside the retail trading perspective, we have probabilities of the underlying reaching a certain price. We have the probability of it going outside your short strikes on an iron condor. Those type of things weren't available at all to the retail investor. And that has really evolved. I wrote a book called The Options Playbook. And when I was first writing that book about 10 years ago, not a lot of people even did iron condors back then. They were just, people were becoming more and more sophisticated in that realm. And now there's people that are doing this on a weekly and a monthly basis. I ran some of the numbers. Actually, the SPX weeklies are one of our top traded underlines, and it has a lot to do with people trying to sell premium and try to bring in premium. Actually, on the volume numbers, what's really kind of weird in the retail space where you don't, as opposed to the institutional space, is about 75% of our volume is in 10 tickers. And that has a lot to do just with the liquidity overall. But the biggest one is the SPYs. The SPY is the biggest ticker out there. But things like the weeklies that have came around, people are really excited about trading them, and the volumes have grown immensely in that area. But when we get to the 20th ticker, which is GE, we're less than 1% as far as volume is concerned. So I think that just has a lot to do with the liquidity. I think that retail clients are becoming more and more sophisticated overall. And that's probably the biggest challenge overall, is trying to find other underlines that they can do these type of advanced trades in.
So liquidity is definitely the biggest challenge you say facing. Would you also say on the other kind of leg of that, you know, pun intended, we've kind of trained up, we've created this subclass, this subcategory of very sophisticated retail clients and end users, and they've come up learning how to hit a bid, lift an offer in a thing like an MBBO and very tight options like Apple. And they progress to the next level, which is what the industry wants, which is of course spreads, right? Then all of a sudden we see the execution in spread land, maybe a little bit different, the MBBO and spreads. Right. I don't envy you guys on the brokerage side having to then explain, well, wait a minute, there's different fragmented spread books, they don't talk to each other. So is that an area where you guys are encountering some challenges as well?
Yes, as a matter of fact, after our initial phone call where we kind of talked about some topics, I actually did some research, and I was actually kind of amazed to find out, in our world at Ally Invest, about 30% of our trades are in options. Out of those 30%, 10% of them are actually spreads. And spread executions, sometimes we struggle with a little bit, and that's one of the areas where I'd really like to see us evolve a little bit more as far as the complex order book that we've seen, and clients getting more access to that. We do actually have some clients that will leg into spreads, and I don't quite understand why they have to, or we have to call the floor and say the natural market is there, we need to get an execution on this trade. And we don't have those issues at all in the single leg space, but as we get more and more advanced and we see our clients doing more and more advanced trades, we're running into that issue a little bit more. I'd like to see a little bit more transparency across all the underlyings as far as spread trading is concerned.
And Tony, you wear a lot of hats these days, including in the retail space these days. What are your thoughts on kind of the overall evolution of that audience from back in primordial ooze of 2007 till today?
Well, besides the tools and education, clearly they're just the beginning of the COBs. Now you have COBs and integrated COBs, but more and more higher-end retail are accessing third-party liquidity. So the retail firms have struck relationships directly with the liquidity providers. We kept track of the licensed liquidity providers on all of the exchanges through the 2008 financial crisis. And in 2007, there were about 180 sole props all the way to the big combines or consolidators, as you would call them today. Within a year, that was cut in half. That's how much we lost during 2008. And today, it's the registered liquidity providers are about 60 firms. So that shows you the obligation that are on the exchanges have really consolidated down to the big guys, and not very many others that are making markets. So that liquidity is a big factor. With 15 exchanges, that's a big factor.
Mm-hmm. And Bill, as a representative of the last exchange to have an educational arm for retail, I want you to weigh in on this too. I mean, I like what CBOE does with the Options Institute. I'd like to see more exchanges maybe get back in the education arm. OIC does a great job, obviously, but it's a lot of heavy lifting for a handful of guys to do. So what are you guys' thoughts over there at CBOE on the evolution of this audience that's coming through your institute all the time?
Well, the retail audience, the active trader community, as we like to call them, has really evolved, especially within the index option complex. 70% of our order flow last year in the Russell complex was in sizes of less than 100 contracts, which we tend to bucket as a retail community or active trader community. And I think the contract specifications within the index complex are key for them. You have cash settled contracts, you have good tax advantages with the contract. So, European style, so you can't get exercised early. So for the overlay strategies for the sellers out there, the contract specs are very appealing. And I would say within the last 5 years, within the overall index complex at CBOE, inclusive of SPX as well, that the active trader has been the largest growing customer segment for us.
And speaking of growing, I'm just checking in on our poll here. It looks like you guys are a pretty optimistic bunch, about 8-1 saying you think the options market can outpace the record 5.1 billion contracts that changed hands this past year. That brings us to our second poll. kind of along the lines of what we're talking about here, again, get into the app and make your voices heard. We asked you guys, quite frankly, of these different audiences we're talking about here, which of these do you think has experienced maybe the most dramatic evolution, upheaval over the past decade and change? So head on up over there and make your voices heard. Like the early voting, it's pretty interesting. We'll check in on that in a little bit. We have to keep on rolling. We have so many different audiences to get to. We're going to go all the way back into the corner now to the realm of probably one of the most put upon audience segments in the option space. This is the one that certainly has undergone probably a lot of the most changes and certainly seen the most challenges and hardships. This is, of course, the call them what you will, the market maker, the prop trader, the liquidity provider audience. It's no secret that there are fewer of them now than there were back in 2007. That's one of the reasons I wanted to have AKUNA on the panel with us today. They're representative of one of the few new entrants to that space in that time frame. So we like to see that. I'd like to see a little bit more of that perspective. But Toby, obviously this has been, as I was thinking myself of all the opportunities that are available in the trader liquidity provider space, each of those comes commensurate with its own challenges. Like, the end of open outcry and that sort of thing really has increased efficiency, so you can trade a lot more with a much smaller team. One guy can trade hundreds of products now as opposed to a handful that are in a pit, so that's been a benefit. But of course, we've also seen, switching from that old market maker kind of in and out style to more of a prop trading mentality, which requires more capital and more risk, much different type of thing. The pros, the barriers to entry to the space are high. But I think the con is that the barriers to the entry to the space are high, right? It's an extremely difficult and expensive space to get into. So there's a lot of pros and cons at work over there. I'm curious for you, as one of the newer entrants to the space, so what are your guys' thoughts at AKUNA on the evolution of this audience over the past decade or so?
Yeah, when we started in 2011, we didn't really foresee having to grow as big as we have. We thought we'd have a 30 or 40 person shop and that would be fine and we'd just make a living. But it quite quickly became clear to us that with the nature of the markets these days, you really have to scale. And so the investment in technology that you have to make to be competitive, as technology moves on, as exchanges become more deterministic, it means that you really have to, shoot for the fences and really try and trade as many products as you can. And you're constantly in a technology arms race. So I think the firms that haven't decided to take part in that game, they've had to either trade lower delta ranges to expose less risk to the market, or move into the back months, or take away liquidity altogether. So we've seen that consolidation in the number of market makers. At AKUNA, we've been relatively successful in growing in this difficult environment with sustained low volatility until last year, really. But a lot of firms, I think, have seen that challenge and had to withdraw. We've seen that, obviously, there's been a huge proliferation in the number of strikes listed. Obviously, the weeklies were introduced soon after we started. But then you've got the Mondays and the Wednesdays in the big ETFs and in the SPX. And so that really means that there are all these strikes around that if you're providing liquidity and you have to be on top of your quotes on a huge number of different instruments. Also the spreads, the combos, keeping track of all of those really makes it very difficult. And so you have to invest very heavily in technology, and that barrier to entry that you talk about, from our perspective, hopefully it means that there aren't too many new entrants who are providing competition to us, but it's obviously healthy for the market if there are plenty of liquidity providers, especially when things get busy.
Yeah, those barriers to entry, I've heard numbers bandied about somewhere like a base level of 20 million to not get an AKUNA size shot going, just get a basic kind of operation going seems to be a number I've heard a lot. So it's certainly significant barriers to entry to anyone who kind of just wants to willy-nilly jump into the liquidity providing fray. John, I know you play a lot with these firms as well, looking for your clients to get liquidity. I'm sure you have some thoughts about the evolution of this space, particularly maybe now as it pertains to some of the resurgent volatility, shall we say, in this space.
Yeah, so I think my current role is a great example of the evolution of options, because I sit at Northern Trust and I run our options business, and who would have thought Northern Trust would be doing options? And so from a standpoint of kind of who we service, the needs of those clients is anything from family offices to institutional clients such as foundations, endowments, and the needs of those investors, asset owners and asset managers can be very different. And so very pleased to see more asset owner types getting into the space, trading options from simple strategies to certain complex ones.
Anyone else on the market maker audience before we keep on rolling? We have a lot to get to. All right, we'll keep rolling then because there are so many buckets. One of the ones, one of the reasons John is here, one of the, I think for us, the more interesting and surprising new audiences that kind of came online for us over that 12 years or so period is really that, you can call them what you will, call them the loosely lumped together as the advisor audience, but it kind of means the RIA, it means kind of the asset manager, the guy who's running the fund, as well as the pensions and endowments. When we started the Options Insider, that was really a negligible part. We didn't really consider them at all because they really weren't playing to a large degree. And then over that past decade or so, there's been a lot of outreach efforts on behalf of the industry. I know the OIC has a whole advisor team that's just dedicated to that. Now we create content aimed specifically at that audience now called the Advisor's Option. And it's, from an audience perspective, it's challenging because on the one hand, they're financially sophisticated. They understand most of the things. When you get to options, most of them are probably not that experienced. So it's kind of a bit of a hybrid audience where on the one hand, they're sophisticated. They can do 10,000 covered calls at a time. On the other hand, when it comes to sophistication, they're more like a very basic retail type audience. They want very basic education. So it's a bit of a nice dance when you're dealing with this audience to work with them on the level they want without A, overwhelming them, or B, maybe talking down to them. So this is kind of interesting for us because this is a relatively new audience that's come online for the space in the past few years. And John, when we're looking at this space, I'm always amazed more advisors aren't diving into it for a variety of reasons. First off, what's the big terror thing you hear coming out of the advisor audience all the time? Oh, it's the encroachment of the robo-advisors, right? So they're coming in, they're going to steal my business. Well, options are a perfect counterpoint to that. They're still relatively high touch, still require a little bit of sophistication that the robots have yet to be able to really reproduce. So that's a great way to stand out from that, to defend yourself from that foray, and also maybe to stand out from the guys down the street who don't do this type of thing. It's a great way to really make yourself moving in that area. Also, we've seen a lot of evolution in terms of the fund space. So see, a lot of these funds used to have these very restrictive prohibitions on using the dreaded D word, derivatives, and a lot of that has thankfully gone away. Again, thanks to a lot of the outreach in the industry and talking to the gatekeepers and the fund managers out there. We also see new products out there like BXM and others that are trying to really simplify the process of looking at a thing like a covered call on the S&P and putting it in terms that an advisor can understand. So John, I'm curious, like you mentioned, your very presence on this panel is kind of a sign of the evolution of the space. What are your thoughts on the complete announcement and arrival of this audience in the option space over the past decade?
Sure. So a few things. First and foremost, from an advisor standpoint, and where kind of Northern fits into this whole equation is we don't look at it as kind of one set, execution solution. So the needs of, let's just say, the general RIA that would have its own, commingled vehicles or own SMAs that they sub-advise for other investors. From our standpoint, we look at things a lot more holistically. So collateral management, operations, trade ideas, and execution is kind of the things that get serviced in-house for Northern Trust clients. And so the opportunity set that we kind of see is very different amongst any RIA. So we have clients that are trading simple covered call strategies benchmarked against a BXM or a put-right strategy where you're selling vol, et cetera, for those type of clients. The needs of those individuals can be very different. And so we try to look at different ways that we're able to optimize and systematize for these advisors to make them stay as relevant as we believe they are.
And you guys think this space is relevant, but perhaps not moving as much. Looking at your poll results here, 75% of you saying the retail audience has experienced the most dramatic evolution over the past decade. It's kind of hard to argue with that. They have evolved quite a bit, so there you go, Brian. That's a win for you there. Then we have, 17% for the RIA advisor space, and it's hard to see here, and then about 6% for the trader liquidity provider. No love for the institutional, Tony. I tried to get you out there, but no love. Bill, you guys obviously do a lot of outreach there at RMC. Speaking specifically to this audience, panels on things like getting the gatekeepers on board with the funds and things. I know this is a big audience for you guys, as well as I mentioned BXM earlier. What are your thoughts on the kind of just complete arrival of this audience in the option space over the past decade?
Well, it's been meaningful as well. We host, I think we had 4 risk management conferences last year. We do 3 big ones, one in the United States, Europe, as well as Asia. And we did a one-day conference in Tel Aviv with a lot of alternative managers as well joining the fray over there. So the global growth of the interest in the options complex is massive. specifically in the alternatives bucket as it relates to the pension funds and the asset managers, we focus a lot on the consultants. We have an entire staff of global buy-side salespeople at CBOE, both on the future side as well as on the option side, going out and engaging these folks in conversations, and the consultant community really is the key. Oftentimes on the pension boards, you've got firemen, you've got policemen, so if you go in there and approach them with strategies, they kind of can get cross-eyed fast. But we also have benchmark indexes, things like the override index, the BXM, or the put right index. And these indexes and the calculations and the drawdowns and the Sharpe ratios associated with these indexes, in other words, the performance metrics, allow these investors to do backtesting data. And the white papers that we handle with the consultants, the consultant community writes white papers on the strategies that are associated with this benchmark. So that's kind of an example of how the ecosystem is serviced from a holistic perspective. Not only do we go out and speak to them individually about strategies and products, but then through the benchmark index as well as the white papers, you can really round out the conversation and get them. And I think, the best example a couple of years ago, I think simultaneously state of Hawaii and the state of South Carolina each put $2 billion in overlay strategies on S&P and Russell. So, it's massive when they come in, and then that helps liquidity into the market making side of the equation. That fuels a lot of growth.
Anyone else on the RIA space? Going once, go back kindergarten, raise your hand. Go ahead, Jim.
One thing I'd point out is, I think if you ask most people, and if I took just a polling question and asked, during that period, we're talking from 2007 to 2018, over those 10 years, do you think more or less options are traded in open outcry on the floor? And most people would say, floors were going away, floors were consolidating. I think someone slipped on a panel once, we won't mention the name of the firm, but they predicted floors to be closed at a certain, and I think they even put a date on it, unfortunately. Well, obviously that's not the case. We've seen a new floor open, obviously right here in Chicago. And that speaks to that value add that those, maybe there's not as many market makers as there were 10 years ago, but by far there are definitely, if you look at the flow that goes through the firms, the brokers I'm speaking of, that flow and that sheer volume, it is by no means down over that period of 10 years. It's flat and it's probably up. And I can't speak for every exchange, and most exchanges don't publicly put those numbers out. But I will tell you that the value add for the type of flow John's speaking to, and that high net worth individual coming down with maybe a complex trade that needs some special service, or a size volume trade that also would lend itself best to being serviced by a broker and going in for price discovery. That's still happening. It's a strong part of our business, and on that note, it's a shameless plug, but we're rolling out a new San Francisco floor. It'll be ready in a couple months, and that again speaks to our commitment to both of our floors, and it is a big part of servicing that flow as we speak.
Yeah, you're at that high touch business. You're right, has remained relatively persistent despite the ebbs and flows of the rest of the business. There certainly is a clientele that wants that and indeed demands that. And you're right, you look back to 2017, it was kind of the year of the return of the floor. We had Box launching a new floor, we had NASDAQ reinvesting in the old Philly floor. Obviously you still have flow over there on Amex, so you're right, there is still a core constituency of that audience. If we had more time in this panel, maybe that could be another audience to talk about the evolution of the floor to upstairs. But unfortunately, we have to keep rolling here to another audience that we see a lot here and have dealt with a lot over the past 12 or so years, which is, kind of, you lump them all together as the general institutional audience. This has been a tumultuous period for this audience. Not that long after we launched, we started getting into the wild, wacky days of late 2007, and then we all know what happened in 2008, and we're kind of still living with the ramifications of that. We saw this side of the audience in particular really hit with wave after wave after wave of new regulations. Things like the Volcker rule coming in and stripping out some of the liquidity in the space, and other changes that are still ongoing a decade or so later from the meltdown. We still haven't really seen all of the full fallout. We also saw over that period protracted periods of low volatility. 2007 kind of comes to mind, but there were others within there, as well as a general plateau in overall options volume. Obviously we hit a record last year, but if you look back before that, for pretty much the better part of the decade, from about 2011 to 2017, the industry had plateaued around 4 to 4.2 billion contracts, and it couldn't really bump above that level. So there were a lot of headwinds facing this audience over that time. Tony, you're holding down the institutional chair today. I'm curious, for you looking back on that time frame for that audience, what are some of the biggest evolutions you've seen in that space?
think market structure is the largest change in terms of, I think every shop now has a market structure specialist or head of market structure analysis. The way the exchange environment is such with the tier structure, and it all ties into, you know, quality of execution, that most of the institutions have gone, at least, I mean, RIAs are part of institutions, retail, you know, each shop that we deal with has a little bit of each of these client types. So technology is at the center of all that, and the ability to navigate the structure and source liquidity. I think the biggest change we're seeing in the last year, I mean, we created a platform 15, 16 years ago that was deemed an ATS, which is an insane thought in the options world, but to pair and match orders within our client base before it goes to the exchange. Those are actually proliferating now, where a lot of institutions, and being a market maker for many years, I get it, you can't make markets in all of the strikes with your best and deepest price all the time, but if you're given a moment to think about it, it doesn't literally mean, you know, 15 microseconds or less, you'll give a better price. And the institutions now across the board are looking for systems that are fast enough for order flow that's smaller volume than you can imagine, to seek liquidity from the same providers, but in a different manner before they're brought down to the exchange. And outcry is not going away, because part of that liquidity provision is in-house capital commitment, and they want to be able to take part of that order, so they are going to bring it to a broker that will handle it on some occasions. Maybe it's only 10 or 20% of the flow, but that all has to do with proliferation and fragmentation of liquidity due to market structure.
And Toby, I know you guys play a lot with this audience as well over there, particularly as the tech impacts this audience and has over the past decade. So what are your thoughts, similar to Tony there, what are your thoughts in terms of the evolution of this space over the past decade or so?
Yeah, I think a lot of the players who've been squeezed out of the pure liquidity provision space through that sort of technological, you know, arms race, they've been able to acquire, you know, reasonably priced technology and take part in a slightly different style of trading, but still remain active through the sort of the reasonably priced alternatives. And they're not going to be making top-of-book markets in a whole strip of options across, you know, a bunch of different expiries, but they can be selective and be competitive that way. And so through the various firms out there, that provides an alternative platform for these guys.
John, same question for you. Obviously, you interact with a lot of the institutions out there in a variety of different capacities. At Northern Trust, what are some of your thoughts on the evolution of this space?
Yeah, so we see kind of really the whole spectrum. So a lot of the value that we provide to clients, this is across retail all the way up to institutions, would be to be able to source the best price at any given time with the deepest pocket of liquidity. And how that is usually done is still kind of the old-fashioned way to trade it. That's sourcing liquidity through people like Toby's firm, and to be able to, you know, show true NBBO or better than NBBO pricing, and then print it on an exchange. And so that's kind of how really we run the business at Northern, and I really don't see that changing anytime soon.
Bill, obviously the institutional crowd, big players over there at CBOE as well. What are your thoughts on the evolutionary trend you've seen out there?
Yeah, I think there's definitely been a solid proliferation of upstairs liquidity providers, especially as the banks shut down the prop desks, you know, post the Volcker rule. A lot of guys migrated upstairs, and I put on my old bank trading hat and know how we used to price prints. As John alludes, that's really still taking shape and form every day, and there are more and more players, very good, smart players that understand liquidity. So a lot of times trades come down to the floor, especially in institutional block size, you know, fully crossed. And then obviously the market maker participants can participate as well, whether it be through electronic crossing mechanisms or an open outcry. They have an opportunity to play. So the ecosystem itself is built to fuel it. And I would say that, you know, what we promote at CBOE, which I think is really important for the industry to promote, is the end user demand drives the liquidity equation. And I think over the last year, especially as we kind of came out of the February vol surge and implied correlations in 2017 started to go down, we've seen a wider array of stocks trading. So liquidity has now broadened out. I can tell you that 48% of our flow is interacting with market maker to customer on the CBOE in some of our index products. So market makers matter. And in order for the industry to continue to grow, they're a critical component of the ecosystem that needs to exist. But if the end users keep coming, the market makers will show up, as well as the upstairs providers. I think the options market's pretty healthy.
Well, clearly our audience agrees with you with those poll results there. Let's keep going to our fifth audience here as well. Another one that's near and dear to this crowd. This is kind of the loosely lumped together industry professional kind of crowd. We started servicing this audience way back with our very first show. I used to jokingly refer to it as our industry Charlie Rose show, our interview show, and it's kind of become, it was at the time back the first ever options podcast. It's kind of become, I think it definitely is the longest running one now as well. So it's that's a fun one to kind of speak to this audience. And this is another audience that has seen a lot of evolution and change. You know, on the exchange side, obviously proliferation of venues has kind of been the theme. Look at the numbers we talked about earlier, going from 6 all the way up to 15. There are more rumored on the horizon just in the last few weeks. So there's a lot of explosion of new entrants, you know, MIAX, obviously BATS, and then we saw a wave of a little bit of consolidation as we went from large exchanges to exchange groups now, where we have a handful of exchange groups kind of dominating large sections of the flow out there. So it's been an interesting audience to watch the evolution as well. You know, Jim, I want to start with you. You're obviously, and this audience is near and dear to your heart. Looking back on this past, decade and change of evolution for this industry crowd, what would you say is some of the biggest changes in evolution you've seen?
Unfortunately, I think, and most people would agree with this, no matter what side of the fence you're on, touching option flow today, there's been just a almost unbearable amount of Me Too exchange opening up. So we at NYSE operate 2 exchanges. They're purebred models. One's maker taker, one's the pro rata traditional side. Both operate a flow, of course. And we actually sit on a 3rd medallion, which would be very easy for us to light up, and we've talked about in the past. So you might say, well, why don't you light one up? Everyone else is lighting one up. We're up to 16, or we will be. And that's a very simple reason. It's you listen to your customers and you hear them, again, no matter what side of the fence, market maker, retail side, they don't enjoy seeing a Me Too exchange, but yet I don't recall one closing down. So with that said, the reason why we don't move forward is it would probably look more like a Me Too. It might be a blend of a pro rata and maker taker, whatever it might be in the model, but it's already out there. And when we did come close a few years back, and it's not, we weren't public about it in the sense we were out there trying to sell it, but we came close to coming up with at least an idea that we thought was actionable and would bring value and have that customer experience be better. And we came pretty close to having something actionable, but we never moved forward because we weren't comfortable that we were going to add enough value to warrant opening up a 3rd exchange. And if you think about it, no other exchange, at least my opinion, is in a position where they have a medallion sitting there with so much SRO equity volume, which of course with cross-asset pricing, et cetera, is very, it's a nice advantage to have, but we don't have an option platform on NYSE today for that reason. So it's a challenge, and I think the market makers, when you look at their display liquidity, and everyone talks about, the top names having you mentioned, Trade King side, 75% of the volume coming from that core of, what was it, 25 names, 10 names?
10 names, actually.
10 names,
Yep.
75% of the volume.
Yep.
And that's a great platform. It adds a lot of value, but how do we grow after that? And I think that's the problem, is you have to identify what is causing the problem and not trying to just treat a bunch of symptoms around the problem.
Bill, the same question for you. Obviously this audience is near and dear to your heart. What are some of the biggest evolutionary changes you've seen in that crowd, that audience over the past 12 years?
Well, we operate 4 medallions at CBOE since the acquisition at BATS, and we did not remove a medallion. We're obviously going through a rather large technology migration, as everyone is aware, as we shift the legacy CBOE models, medallions, over to the BATS technology. And once that's complete, I think in line with Jim's comments, we have to make some serious decisions, as well as strategic looks at how we're going to run the medallions to make sure that they're providing value. What I would say is, to complement the many medallions that exist, though, is that there are a number of players within the option system that require different types of execution methods. And there are a number of types of market makers that like to play from different perspectives, be it price, time, make, take, pro rata, so forth and that. And, you know, to the extent that you provide medallions that help those particular entities execute and engage, you can thus create liquidity. So it's a fine line, no doubt, but the system seems to be handling it, and we're very happy with how we're positioned presently.
Anyone else on the industry audience before we keep on rolling some of the big obstacles?
I'm just surprised that Jim said they're only sitting on one medallion. They're actually sitting on two.
Thanks for the line.
Toby?
Well, two that you know of.
Yeah, from the market making perspective, it's obviously extra cost if we have to, you know, connect to more and more exchanges, and this fragmentation isn't particularly helpful. But you know, we're in business; we have to go where the flow is, and so if it's all spread across more and more venues, then we're, you know, locked into that. So it's contributing to those barriers to entry that you talked about for the liquidity provider space. Now that we're in the game, we just have to, you know, play what's on the table. But we wouldn't mind if one or two went away.
And we're going to shift from looking back a little bit to looking ahead. You guys can play along with this one as well. It's our third poll here. We're asking you guys, what are the biggest obstacles facing the options market here coming up for this year in 2019? I can read off the answers, but I don't want to cheat and give our panelists any free answers. So we're going to go around the horn and have everybody chime in on this one. Let's just go in order. Brian, we'll start with you. Looking ahead to 2019, obviously you look at it through the retail lens. What are your thoughts on kind of the biggest obstacles we have in front of us right now?
Well, it's always in the options space, it's just education. You need to have as much education as possible. As a matter of fact, we have a registered investment advisor, since we were talking about that space, that actually educates their clients. They're one of our biggest clients, period, on what they do in their strategy. And then they say, here's how we do it. If you want to do it, here's the tools. But we'll obviously manage your money if you want to for a small percentage. But that's basically the way that they approach it. So in the space, in general, what we hear from our clients is they want more education. The interest is out there. The people are willing to learn. And if we educate them, we don't lose the client. It's the attrition rate is very low once we bring them into our education process. And we're not trying to teach them overall strategy how to manage your entire portfolio, but just the basic concepts of it. And once they get a grasp of it, we usually don't lose that client.
You're right, that is an important thrust. We hear that a lot at various industry events. It's one of the reasons why I wanted to have you on. You represent one of the few brokerage firms out there that has a dedicated educator on staff actually producing content in the options playbook. It does seem like we hear that a lot. Education is important, and you're right. It seems like a lot of the industry has moved away from that. So hopefully that'll be a trend. Maybe we'll see a reverse of that. Basic retail education will get sexy again in 2019. Tony, same question for you, sir. What are the big obstacles out there lurking for us in 2019?
Regulation. I think that the over-regulation of our industry in general, I'm just talking about the securities industry, stifles the growth of business due to the fact that it's difficult to start a broker-dealer, which is the hunter and gatherer, if you will. It's a lot harder to get started today. Some firms have more compliance people than salespeople on staff, and it's overregulation, I think, is the bane of our industry, and it actually doesn't solve the problem that they say it's supposed to solve. So that's where I'm at.
That's right, Bill. Same question for you, sir. Biggest obstacles lurking in 2019.
Yeah, I don't know if I'd classify it as. Oh, I'm sorry. I don't know if I'd classify it as an obstacle and opportunity, but you know, shameless plug, I'll say volatility. Volatility.
Why would you say that?
Volatility's returned, obviously, in 2018 for the first time in a long time. And I think everybody from mom and pop retail to your tier 1 level institutional accounts realize just how effective we are in a globally allocated portfolio. I think there's positive correlation between bond prices and equity prices as the interest rate situation unfolds, as the China trade agreements unfold, and whatever the hell else Trump can throw at us. With his tweets. So I think that one of the biggest opportunities is for education around volatility as an asset class, and for factor modeling to kind of take a look at portfolios and recognize how much exposure they have and how they can tune some of it out through the use of derivative products. It's not just that, it's a host of products. But certainly I think that's probably the greatest opportunity / potential obstacle if you're not prepared for it.
Does kind of fit in both levels, depending on where the VIX is floating around these days. James, a question to you, John.
Sure. Yeah, so I would echo education. I mean, Northern, we invest a lot of resources in educating both our internal audiences across both wealth management and asset management and corporate institutional services, and then our ultimate client base. And so it's something that I personally focus on with all of our clients. And then the other point I would mention is when periods where volatility is a little bit wonky, and so is the broader market, is liquidity. And making sure that we are able to continue to trade and source liquidity at proper prices, irrespective of the environment that we're in.
Right, education. I mean, everyone thinks it's just for retail, but we mentioned before that at RIA, who has 200 million AUM, you might want to learn how to do a covered call as well. So there's a lot of utility beyond just the 10-lot retail guy. Jim, same question for you, sir. The obstacles looking forward to 2019.
Yeah, my vote would be educational as well, but in line of the shameless plug, Bill, I'll put my own in. A good example is we launched a product, a Fang Plus product, shameless plug. We didn't get as much traction as we thought, but what we did do is we quickly pivoted to let's get out there with the retail folks, the folks that are willing to at least host a webinar with us, do a joint webinar, get some information out to their clients, and we have seen our volume pick up in that particular product. And that I don't think would have happened if it wouldn't have been for those partnerships that we're forming. And again, this is a new product. It's 10 equally weighted names. It's the 4 Fang original names plus 6 more added to it. It has a 42, 45-ish implied vol, which is probably #1 in all the index space today. But it doesn't trade a lot, and it needs to have an educational piece, and it's just a great example of a little bit of education going a long way. And we look to do more of it. And if there were more bodies, I think you mentioned OIC, a great example. If there was 10 times the educational arm of OIC, we'd all have a more fruitful experience.
There you go. I'll put you on the spot. Now's your opportunity, Jim. You can announce the new ICE Educational Options Initiative for 2019.
Not this year.
Not this year. Someday soon, hopefully. Toby, will end up with your biggest obstacles looking for 2019.
Yeah, from the liquidity provider space, it's really the balance sheet constraints on the clearing banks that really holds us back from providing tighter liquidity at times, and especially close to the end of the month, where our limits are enforced. I don't know yet. So yeah, we've had some help from CBOE and from CME as well in terms of helping us offset our positions and with other liquidity providers so that we can stay under the limits and continue to stay tight. But it's really been a challenge, and hopefully the politicians sort it out before too long.
I'm kind of coming up against this, so maybe I'll combine our last 2 initiatives into one combo question here. Obviously, let's look ahead. Let's end on a positive note. We talked about the challenges. Let's look ahead to the opportunities. And that could come in a couple of different areas. Maybe there's a new product, because obviously new products have driven a lot of volume over that past decade and change. Obviously, SPY options have really taken off. The VIX options, we've seen some launch with a lot of fanfare, like the minis, and then maybe not so much, or binaries, so some have fluttered. So maybe there's a new product coming that is ready to go, that maybe you think could pose a lot of opportunity for the space, maybe a product category. We hear a lot about crypto, maybe that's the one. Or perhaps maybe there's a new audience, maybe one we haven't left off our kind of audience buckets here today that you think is going to be coming online soon in the coming years. They might be a huge driver for volume, if we do this panel a decade from now. We'll go back the other way. Toby, we'll start with you.
Yeah, we're very excited to see crypto options. I think it would bring a whole new demographic to the world of options. And we look forward to our friends at the exchanges doing their best to get those launched as soon as possible. We have a pretty active OTC option desk, and we market make the futures and the individual coins. So it would be a shame for that part of the business to see it all go to exchanges, but we think the volumes would be astronomical, and it would be in the exchanges' interests as well as ours.
Jim, same question for you. Toby set you up. Now you can announce the new crypto initiative
I would like to see some industry movement to get the issue. I think we kicked off with this NBBO issue around complex spreads. And if you recall, implied outs, and I guess that's about 10 years old as well, rolling out and how much that helped that particular problem. So if you take the quoting obligation should be in line with rewards for a market maker, and get your RWA in check, and that I think is on the right track to be changed, or at least it seems that way, and all this falls into place. It would be nice to see, might not be an exchange coming out with an implied out 2.0 solution, but for the retail folks looking at a spread and seeing it 2-bid at 202, and that's really a non-offer by an offer bid. You know, you have to solve that problem because that's hard to explain to a retail customer. It's probably the number one complaint on that side. And spreads are growing more and more.
Definitely. Speaking of the challenges, let me pay off your poll here really quickly. It looks like you guys are leaning towards fragmentation of being the big winner for the biggest obstacle for 2019. Followed closely, number 2, by your point earlier, Brian, about liquidity. And we're continually seeing the half of the business getting down below 20 names now. Not a trend that's kind of favorable. And the rest of you are kind of tied with regulation and margin capital requirements. That's also another popular one. And a lack of new products / innovation in the space. So interesting to see where you guys fall out. John, same question for you, sir. Looking ahead, maybe there's a new product or a new audience you think that will be revolutionary to the space in the coming years.
Sure. So kind of more, taking it more broadly, I'm just excited about kind of things that we're working on at Northern. I mean, we're one of the very few broker-dealers on the street that is proactively growing in the broker-dealer space, both in integrated trading solutions, which is something that we launched on the equity side back in the fall here in the U.S., and internationally, and then options. I mean, our option business was just started in 2015, and on any given day now, we are about 3% of OCC volume. And that's, for us, that's a big number, and it's certainly something that I see growing in the years to come.
Bill, same question for you. Toby actually teed you up. Here's your opportunity. Great news. New crypto options coming from CBOE right now.
Well, we certainly have the Bitcoin futures. We're monitoring that very closely. I think we have to let the futures market mature with some liquidity before we feel as though it can support the options game that would ensue. So obviously that's on our radar. There's some things, unfortunately, I can't mention, but we do have some interesting things coming out, so stay tuned. But I would go back to the RWA issue that was mentioned earlier. I mean, last year we were able to get successfully, unanimously through the House Financial Services Committee a vote on behalf of getting interpretive relief. So we're obviously pursuing that with the folks in Washington. I don't know where we're going to wind up, but I think as an industry overall, and from a liquidity standpoint, that would really be a game changer for everybody to benefit from.
I'm surprised that the capital requirements didn't rank higher on our list of obstacles there. Tony, looking ahead, I have a feeling I know where you're going to go, but what is the area of excitement for you, sir?
Yeah. Cryptocurrency derivatives, international.
Yeah, so yeah, that's obviously a hot area. So I guess we'll end where we started. Brian, last notion goes to you, sir. What are the assets, the products, the opportunities you see coming forward, maybe new audiences for the option space going forward in the coming years?
I would almost just say stop. In other words,
stop. We should shut the whole thing down. We're done.
We're making so many products, and our clients, just the liquidity and the half-point strikes, and like the TVIX over the last year, we had a lot of clients that ended up getting licked the deficit from the way that thing traded. And you know, they end up doing a reverse split, and they come up with a bunch of these different products. And overall, the liquidity aspect of it, the markets in weeklies and some of these really good underlyings are just getting wider because we're adding more and more strikes and more expirations to them, and all of a sudden they're not as attractive to trade.
That's about all the time we have. Give me a hand and join me in thanking our panelists. If you have time for questions, or do you want to go afterwards, you are all welcome. So really quickly, if there's like a couple of succinct questions out there, I lied. Very quickly, going once, going twice. You, sir.
What can be done to attract more market makers to the option industry?
More market makers, Toby, more competitors. How do we get them from here?
Oh, free fees sounds pretty good.
And I'll jump in. I think you have to have the rewards for the market makers, along with the issues we talked about, have to somehow, that has to come back in line. And if you look 15 years ago and you saw a market maker provide quotes on the screen, and then perhaps the same firm out in the open outcry, there's always been a reward and a balance for having that obligation. And it's probably the weakest it's ever been. So I think that needs to start to at least stabilize. It needs to go the other way.
All right, I see the next panel lining up. Thank you very much, and it was fun.